Good morning, everyone. Welcome to the new week. Welcome to the Macro Snapshot. We are Monday, July the 28th, 2025, recording this in the morning. Let's just have a quick look over the weekend, see what happened. Obviously, the big news was that there was the so-called sort of deal between the European Union and the United States. We saw that Trump met European Union Commissioner von der Leyen over the weekend. And basically, it's looking like it's going to be 15% tariffs on everything, including sort of pharmaceuticals. Aircraft are going to be excluded at this point, but it's going to be 15% across the board, including pharmaceuticals, as I said, and cars. The EU has agreed to buy apparently $750 billion in US energy, although a lot of those deals have already gone through in terms of LNG. The EU has also agreed to invest over $600 billion in various projects into the EU. Into the US. So what I've seen is that essentially some people saying it's a bit of a victory for the US and it's a little bit one-sided. But having said that, a lot of the sort of the energy deals and the other investments have already been sort of pre-announced over the last year or two or three and are going into the future. So I don't know how much new investment that will be. Now, the big question here is also, is this positive? It's positive in the sense that there's a bit more clarity and certainty. And initially, when we had this news, there was a sort of a risk-on sentiment. But the reality is this going to be sort of medium-term and negative for growth? Just because, at this point, we have 15% tariffs on Japan. We have 15% tariffs on the EU, broadly speaking. On certain sectors, for example, steel and aluminium, it's over 50% still. So the question remains, is this going to be sort of a stimulus to global growth, or in fact, will it start causing a slowdown? And that's why the market is rethinking. And we did have some initial sort of positivity, but it's faded somewhat. Secondly, over the weekend, there was the information that the so-called trade truce with China has been extended 90 days. So it looks like they're going to still keep on negotiating over the next sort of 2 or 3 months. So nothing going on there. So if we look at the market reaction, fairly muted. The initial reaction at 6 p.m. last night was, risk on and sort of clarity, which is good for the markets. But we can see here that the ES minis or the futures in the US, they had an initial pop, but they sort of come down a little bit. Now, this chart is still very sort of positive. And again, one of the dangers is sort of, prognosticating into the future a big slowdown. We don't have that yet. We will have a lot of data this week, which I'll get onto in a second. But so at this point, this is still a very, very bullish chart. Still going up. There's nothing negative to say here, but not really euphoric. And if we go across over to the European stocks, we can see on the Euro Stoxx 50, they sort of gapped upwards, but they've since given back some of that. And if we look over in Germany, similar situation that they gapped higher and have come back down. But having said that, the stock markets sort of globally are sort of quite positive, and maybe the clarity will sort of outrun concerns about sort of medium-term growth. If we look at some other markets and just see the reaction, interesting. Just looking initially, we had let's, for example, look over the German bonds. We had the bonds, which was sort of logical in a sense, selling off, but they've since come back. Not too much of reaction in the US bond market. But what's got my attention is if you look at oil, even with this sort of so-called sort of positivity and the so-called sort of deal and an extension of the trade truce with China, look at oil, just up 80 cents. So, and it's not collapsing, but not a very sort of weak reaction if this were a true sort of risk on a kind of reaction. And also, if you look at something like copper, just to get a sense of, some of these markets, if we look at copper, which is here, the high grade, you can see that that's sort of particularly unimpressed by the trade deal. And the other thing as well, just to finish on that, is just looking at the euro, and we can see here that the euro versus the US dollar has actually come down quite a lot. So there was initial sort of few ticks upwards, but basically that's come down quite a lot. And you can see here that the US dollar also up quite strongly, breaking out against the Japanese yen, breaking out above the 200-day moving average. So the dollar pretty strong here. So it looks as though the market is saying that net this is a bit more sort of one-sided in favor of the US. And the market is quite liking the clarity and just sort of thinking that this is not fantastic for European sort of assets. And certainly there could be a little bit of sort of a pause in this thinking that US assets have to be sort of deleveraged and sort of pushed over into Europe. We shall see. But what we do get this week, we do get a huge amount of data. So I think that the point here is that the market is a little bit skeptical about these trade deals. And it wants to know how these are actually going to affect the sort of global economy, and that's going to be through the lens of data. And we start to have quite a lot of data this week. We can see here today's the 28th, not particularly a lot today, but starting from tomorrow we start to get the JOLTS number from the US, so we'll get some information about that. We get some consumer confidence. We get the ADP employment number on Wednesday. Then we actually start to get some meaningful sort of data on GDP on the 30th, which is Wednesday as well. So that's the first read, the advanced read for the second quarter. So we're going to start getting a sense of what happened in the second quarter in terms of the GDP. We'll also, of course, get the Fed on Wednesday. Now they're expected, of course, not to do anything in the sense of not to cut, but their guidance and commentary is going to be very, very interesting. We also get personal spending, personal income, PCE. All of this is coming later in the week. And then on the Thursday, as always, we get the initial jobless claims, continuing claims. And then just to top it off on the 1st of August, which is on the Friday, this Friday, we get the non-farm payrolls number, as well as that we get ISM sort of manufacturing. So a huge week. Apart from that, we also get all the earnings. We get 37% of S&P 500 companies are reporting this week, including sort of enormous tech companies. We have these Amazons and the Apples and the Microsofts. All of these companies are reporting this week. So far, earnings have been relatively positive, and the market's quite liked what it's seen. But so the point I'm trying to make is that by this time on Friday, or let's say next Monday, within a week or so, we're going to understand more of the Fed's sort of thinking. We'll have more clarity on the European trade deals. Trump's also announced there's going to be a couple more trade deals coming. We're going to have the earnings. We're going to have a lot more information about employment. We're going to have some sense about the GDP. And we're also going to get a little bit more information on inflation. So a lot of stuff happening this week. Apart from that, we also have the Bank of Canada on Wednesday morning as well. And the other thing which I just want to talk about, which is maybe even going to be more important than all of that, is the quarterly refunding announcement, which actually we get part one of that today at 3 p.m. And we get part two, which is the composition of the funding on Wednesday morning at 8:30. So Wednesday is going to be an absolutely huge day. And just in terms of the QRA, I mean, what's expected? The QRA, as we know, is every quarter the Treasury essentially sort of looks at what the government is spending, any shortfalls, any deficit, and basically decides not only how much treasury bills and bonds and coupons need to be issued, but what is the composition? So today at 3 p.m. we'll get these sort of overall numbers, but probably what's going to be more important is the composition on Wednesday morning at 8:30, where we'll get the mix of bills and coupons. Now, what's interesting here is that we know that Treasury Secretary Bessent has really said that one of his key goals is to keep the 30-year bond sort of yield down. And just while we look at this, why don't we just look at the 30-year bond yield? One of his key goals has been to reduce the 30-year bond yield. Trump's also been saying that as well, to get the economy going. And so there's some talk that they may want to reduce coupons. So I think that's like just looking at it over the weekend and doing some research and having a think. It seems to me that there are sort of four main scenarios, and these are going to have massive implications for the bond market, and therefore also for equities and sort of FX and things like gold. Let's grab some tea here. So the first possibility, let's call it sort of A, is no change. So what's expected is approximately about $1 trillion worth of issuance. But let's say they do the same coupon sizes. And coupons here is understood as, let's say, the 10 and the 30 year. Okay, so the long end of the bonds, which is the most sensitive. So let's say they do the same coupon sizes and there's no change in the forward guidance. That would be, pretty much sort of in line and not any sort of huge change. But what would happen, and this I think is low probability, maybe 1 or 5% or so, but what would happen if they actually didn't change the coupons for 25, so for Q4, but for 2026, said there'd be higher coupon issuance to cover extra deficit spending. So nothing in 25, but in 26. Again, low probability, but I think this would be huge. I think we'd get a huge rise in the nominal yields in the 30-year. I think the 5s, 30s, there would be a huge bear steepening as the long end yields in the 30-year ripped higher. I think the ES at that point, with nominal yields going, you see here, to maybe 520 or 525, something like that, and higher real yields. I think the ES, the futures, the stocks would fall a lot, maybe down to 100 points, 200 points. I think gold would collapse on that, and I think the euro would go down hard and the US dollar up. So that's low probability. But if we do get any mention that they're increasing the coupon issuance for 2026, again, we'll get this information on Wednesday morning. That's going to be very, very negative for most assets, except probably for the US dollar. Now, what about sort of a second scenario, which would be a small reduction in coupons? So not an increase, but actually a small reduction in coupons. When I say coupons, I mean those bonds greater than a 10-year sort of duration. And let's say, for example, they said, and by the way, they wouldn't compensate for that by adding to the coupon issuance, and let's say the 2 to 5 year sort of zone. So the thing is that they can cut the 10-year and the 30-year, but they could actually compensate for that by adding to the 2s, 3s, and 5s. But let's say, for example, they didn't do that. They just said, no, we're going to sort of cut the coupon issuance, and they didn't mention any additions to the 2s to 5 years. That would be an implicit sort of refinancing using bills at the very, very front end of the curve, which would be taken as very, very positive. It would almost be like a QE kind of situation. And if that was something more than, let's say, 75 or $100 billion of coupon issuance being cut, so less coupon issuance, that implies that there is less 30-year and 10-year bonds in the market. That would be very, very bullish. And that would also imply that they want to run the economy hot. And, it's like to be damned with inflation. Having said that, that would be almost like a sort of a green light for US dollar debasement. That was basically saying, hey, we don't really care. We care what's going on with the US dollar. That, on the other hand, this scenario would be extremely bullish. It would be good for commodities. It'd be fantastic for gold on the debasement story. The euro, I think, would rip. The US dollar would down a lot. Of course, the long end bonds, let's say the ZN or ZB would go up, and long ES and the US dollar are down, probably like something like to 96.50. So that would be the most bullish scenario if, as I say, they announce a significant reduction in coupons, no mention of changes for 2026, and no mention that they're going to sort of redistribute that through the 2s and the 5s. So therefore, that would be bill issuance. That would be very, very bullish. You have to be long everything there except for the US dollar. What about a third scenario, which could be a reduction in coupons? So what I just said, like scenario number sort of B or 2 here, reduction in coupons, but that reduction, the same sort of nominal amount, would actually be issued now in the medium part of the curve. So let's say 2s to 5s. So that wouldn't be quite as bullish. So overall, the issuance of coupons would be unchanged, just shifted, kind of twisted from the long end until, let's say, like the 2s and the 5s. So that would still be, mildly sort of bullish for assets. So it would probably be a bit more of a flattener, though. So at that point, we'd have a flattener, and you could be, buy equities. So positive, but not as bullish as the second scenario. Okay, what about, let's say, the final scenario where there was no overall change to the issuance, but it was a question more of the buyback. So they keep the issuance size the same, but they say that they're going to do buyback. So the buybacks would be in those low liquidity off the run coupons, and they wouldn't substitute it or fund them by newly issued on-the-run coupons with the same duration, but via bills. So the idea here is that they would essentially buy back from the market those low liquidity off-the-run bills, and they would, rather than by reissuing on-the-run sort of coupons with the same duration, they would actually fund that with bills. So that basically taking those low liquidity ones out of the marketplace. And they have a couple of possibilities. They could either refund or fund those by issuing bills, which would be most bullish. Less bullish would be if they decided to take the off-the-run coupons from the market, but they actually issued the same amount of on-the-run coupons with the same kind of duration. That would be less bullish. So that's something as well. That would be a little bit like sort of almost like a sort of a QE light situation. So that would be positive for risk assets, but it would have to be more than, let's say, 30 to 40 to 50 sort of $billion. Let's keep an eye on there. So that's what I'm looking at, and they're the sort of the four main things you should keep in mind. We're going to get a bit of a sense, as I say, at 3 p.m. this afternoon with the overall numbers, so that'll give us some clues. But really, the main thing is going to happen on Wednesday morning at 8:30 when we get all the composition, and we'll understand, if there's going to do buybacks or coupons or less coupons or more coupons in 26 or bills or what kind of situation there. So let's keep an eye on that. And just by the way, just while we're talking about the bonds here and the issuance, what is kind of interesting, if you look at something like the US 10-year subtracting the the German 10-year, just interesting here is that you see here, this is the spread here. It's at about 170 as we speak. But let's imagine that there are less coupons being issued, or that they were doing sort of buybacks, and those buybacks are going to be funded by bill issuance. That would be very positive for the US long term, which would push down those yields. And so an interesting trade could be a spread trade, something like a long US 10 years short the German at this point. And the idea here would be that this spread would sort of come in. So that's something to be looking at as a possible trade there. Okay, guys, so I might just leave it there. One thing I just want to keep an eye on is keep an eye on the VIX. We do have the VIX very, very low, but of course there's a lot of risk events happening this week. As we know, we have earnings, we have the Fed, Bank of Canada, we have the QRA, a lot of stuff happening. And of course, we have a bunch of data, all of the employment data. So it's interesting here at the moment, VIX is low, but it wouldn't surprise me at all to see VIX pushing up, maybe even up with all these moving averages here over 20 as we get further into the week, and potentially if there's any kind of nasty information coming from the QRA quarterly refunding announcement, which could cause a push down in the equities. Okay, that's about it. That's all I want to talk about at the moment. So let's start the week. A good day to prepare today, because for the next few days there's a lot of action. Let's see what happens there. Okay, have a great trading day, and we'll keep this conversation going during the week. Thank you.